All right, today is really exciting. Glenn, thanks for jumping on here again.
Pleasure.
In the last sort of 10 days, we've actually gone out to a lot of clients and had them put in some questions.
Yep.
So I've got 7 questions here from clients and from just people out there in the social media world.
Yes.
And they'd love to have a response on these.
Beautiful.
So what I thought we'd do, Glenn, is I'm going to run through these, ask the questions, and we'd love to have your expertise around each one.
Pleasure. Yep, let's go.
Excellent. So question number 1, what happens if you want to sell a property but your loans are cross-secured with another asset?
Sure. So probably the example here is that maybe people are selling an investment property and it's cross-secured with their owner-occupied property. So the idea would be to de-link them, so uncross-secure. What we need to do, ideally before you sell the investment property or the asset, is that we go through the process of refinancing and separating the two assets. So we go out and get valuations on the properties, take the existing one that you're keeping to 80%, that you're selling to 80%. And then obviously when you do sell it, then that can get released without any implications.
Perfect. Yeah, we've actually seen, and I've had this myself with a client, is that their properties were cross-secured, settlement ended up falling over. With another example was the bank actually retained a lot more cash than they were intending to. So what you said, perfect example.
And the banks, just as they can retain more funds depending on what their valuation comes back at. So can be a bit of a sticky situation. It's nice to unwind it first and not be under that pressure.
Yeah, good advice. Next question. Everyone says that it's best to buy with a 20% deposit, but is it really that bad to pay lender's mortgage insurance?
So ideally, yes, it is the best option to buy with a 20% deposit if you can. Now, having said that, not everyone can, so it's not the worst result to buy without the full 20%. There's a couple of different government schemes available, one in particular for the first home buyers where you can borrow up to 95%. Obviously, the idea is then to help first home buyers get into the market, and that saves them from waiting 1 to 2 years to build up those savings. So in that example, absolutely. In the example that you're not eligible for the scheme, yes, it's still worth having a look at it because paying an extra $5,000, say, in mortgage insurance is going to be a lot better in the long run than getting into the market 6 months down the track, in which case it's probably $50,000 more that the property is going to cost you. So ideal situation is 20%. But under that is certainly not a bad situation. Just got to have a look at the figures and understand that there's a slight fee for doing so.
Yeah, when you touch on the good point there is that you need to say if you think the market's going to be more expensive in 12 months' time, spending 5, 10, 15, 20 grand even on lender's mortgage insurance is actually a lot cheaper than $50,000 to $100,000 more in a property.
I've seen it in the past where people are really firm on not wanting to pay the mortgage insurance. They keep building up the savings, but they're chasing their tail. If the market gets away from them faster than what they can save, and they ended up, in a bit of strife, not purchasing. So
here's another one. This was, I think, more about investing. So a client sent in and said, listen, my mate says interest only is always the best way to go for investing.
Yep.
What's your thoughts on that?
Definitely comes back to your personal circumstances. So happy to have a chat with you around that. But as a general rule, the mate is correct in that example if you've got owner-occupied debt. So the idea would be to reduce your non-deductible debt as quickly as possible with an interest-only investment loan. That's going to be maintaining its level, maintaining its tax deductibility, allows you to concentrate on the owner-occupied stuff. So
perfect. Good answer. Well, here's one. Can I rent out my old home and buy a new one to live in? And if I do that, will the previous loan be tax deductible?
Sure. Okay. So a couple of questions there. Can I rent out my previous home when you purchase one? Yes, absolutely. Once you move into a new one, you can rent out that property. The loan at that time then does become tax deductible. So it's important to remember then, perhaps if you pulled out equity to use as a deposit on your new purchase, that equity release is not tax deductible. So that's not for the purpose of an investment loan. It's for you to owner occupy. So that's probably one thing. Probably good to reassess whether or not your existing property is a good investment. Talking location, yields, what rent you can get on it. Another thought is that you could potentially sell that owner occupied property. So the original one that you were in, take your gains as capital gains tax-free, so you're not paying any tax. Then you can come into your new purchase with a much bigger deposit having lower non-deductible debt, and then potentially a debt recycling strategy, or investing from there. So
I think that's probably the wisest way to go. Most of my clients that I always deal with, it might sound good in theory to keep your current home as an investment property, but if you do the numbers, especially if you've had that existing home for a while
and paid down the debt,
the tax saves by selling it and getting that gains for free, and then having a small owner-occupied mortgage, 9 times out of 10 is always much better.
Absolutely.
And then go buy your investments after that.
Correct. You can choose the investment based on investment parameters rather than where you owner occupied, and often they're very different calculations as well.
Excellent. Here's one. I haven't heard something like this in a little while.
Okay.
But a client wasn't actually a client of ours, but someone actually emailed in and said they've actually fixed their interest rate last year.
Yes.
Obviously, rates are now turning and going the other way.
Yep.
What they feel like they're stuck. What could they do?
So, in terms of fixed rates, you agree with the bank that you're locked in for a particular period of time. Yeah. So up to 5 years, the common term is 2 to 3 years. As you say, if they're fixed 12 months ago, the rate's going to be a little bit higher. A couple of options that they've got available for them is to look to refinance. But having said that, there's going to be some exit clauses. Yeah. The existing lender is going to say, we've locked you in for this rate. We want our slice of the pie if you go. So the benefit would need to significantly outweigh the cost, you would imagine. There's a couple of lenders still doing cashbacks, so that would help to sweeten the deal if there was a big changeover fee. Or the other option is that, and it's unfortunate, but you've just kind of got to suck it up. So you've made that commitment for a couple of years, grin and bear it, so to speak, and then when the time comes that you mature, you're going to roll over to a variable rate, and probably then time to reassess where you're heading.
Good answer. Here's one. Obviously, the market's really picked up right now.
Yes. Yep.
A lot more people are buying, and they're buying quickly. Someone's said, how reliable is a pre-approval?
Depends on which bank you go to.
Yes.
So we've been caught out with a couple of, not our clients, but other clients that have worked with particular banks. They've gone out and purchased on the basis of getting a pre-approval, and the bank haven't honoured that one. So then we get them and have to kind of pick up the pieces. But some banks out there will do a system-generated pre-approval. So basically the data that gets put into the system, they will spit out an approval back. And they're not very reliable, unfortunately. Yes. So banks don't want to invest a lot of time or resources into assessing applications that may not go through.
Yep.
So they're a very weak pre-approval. What we tend to do at the Loan Room is that we look out for lenders that will do a fully assessed pre-approval. Your application actually goes across the desk of an assessor. They will look at your pay slips. They will look at your savings history. They will do a credit check on you and give you an approval based on your circumstances. And they're pretty rock solid. So
having a funding position too is important, because I've seen clients who've gone to a bank, the bank's giving them approval. They've come to us and said, hey, Martin or Glenn, here's the approval. You look at it and it's like, you can't actually buy for this amount because you don't have the funds to complete the transaction.
Correct. That's part of the pre-approval, the funding position. How much savings have you got? How much is your purchase price? What are your stamp duties, if applicable? Can you complete the transaction? And those system-generated ones, unfortunately, are not really worth the paper that they're printed on, but coming to see us, absolutely, we go through all of those. And those pre-approvals allow you to purchase at auctions, maybe even get aggressive with unconditional offers if you're doing a private sale.
Yeah. Last question here, Glenn. So someone's asked, why would I want to split my home loan, I should say, into multiple parts? Does that simply make things more confusing?
The reason why you would do it, and probably not common at the moment, is that some people would like the stability of having a fixed rate and the flexibility of a variable rate. So they will have a portion fixed and a portion variable for each of their reasons. Could also be split from an investment strategy point of view as well. This portion was for us to purchase an investment property. This portion is for a deposit on another property, shares, whatever it might be. So they're the reasons why. Yes, it does generate two separate loan accounts, but in these day and age, everything's electronic. So your money goes into your account and the electronic transfers come once a week, fortnight or month, and it's all pretty simple. So it's in fact a little bit simpler too if you've got an investment split for your accountant. You can literally say, here's my investment loan, and all the interest is deductible, etc., etc.
Yeah, perfect. All right, that's great. I really appreciate that.
Pleasure.
For those of you watching, I hope you found that Q&A informative. If you actually have a question that you'd love to ask, put it into the comments, send us a DM. I'm happy to answer those for you.